90% of Forex traders lose money. You've heard that number before. Maybe you scrolled past it. Maybe you told yourself, I'll be the exception. But here's what nobody tells you. It's not because they had the wrong strategy. It's not because they didn't find the secret indicator. It's not even because they lacked capital. They lost because of what happens between their ears the moment real money is on the line. This video isn't going to give you a new strategy. It's not going to show you a proven setup or a magic Fibonacci trick. Instead, I'm going to walk you through the psychological traps that quietly destroy traders, the ones nobody warns you about when you're excited, motivated, and opening your first live account. If you've ever blown an account after months of profitable demo trading, this video is for you. If you've ever watched a perfect setup play out exactly as planned, except you weren't in the trade because you hesitated, this video is for you. And if you're about to start trading Forex for the first time, this video might save you thousands of dollars and hundreds of hours of frustration. Let's get into it. Let's start with something almost every trader experiences and almost nobody talks about honestly. Section 1. The demo account lie. You open a demo account. You trade for a few weeks. You're profitable, maybe even wildly profitable. You feel like you've cracked the code. So you fund a live account, apply the exact same strategy, and within days, everything falls apart. What happened? The strategy didn't change. The charts didn't change. You changed. On a demo account, the money isn't real, so your brain doesn't treat the outcome as a threat. You take trades cleanly, you follow your rules, and you let winners run because there's nothing at stake. The moment real money enters the picture, a completely different part of your brain takes over, the part responsible for fear, self-preservation, and loss aversion. This is not a willpower problem, it's biology. Humans are wired to feel the pain of a loss roughly twice as intensely as the pleasure of an equivalent gain. That imbalance doesn't disappear because you read a trading book. It shows up the instant your own money is at risk, and it will quietly rewrite your decision-making unless you're aware of it. The hard truth? A strategy that works on demo isn't proven. It's only proven once it survives contact with your own emotional response to real risk. That's a completely different test, and most traders never realize they haven't passed it. Section 2. You don't have a strategy problem. Here's something that will save you years of wasted effort. Most traders don't need a new strategy. They need to fix the way they execute the one they already have. Think about how many strategies you've tried. Price action, moving average crossovers, support and resistance, supply and demand zones, maybe even a paid course or two. And yet, the results stay roughly the same. That's because switching strategies without addressing your psychology is like changing the furniture in a house that's on fire. The problem isn't the furniture. Ask yourself honestly, when you lose 2 trades in a row, do you stick to your plan or do you start adjusting, tightening stops, doubling position size, entering trades that don't actually meet your criteria? If the answer is the latter, a new strategy won't fix that. You'll just find new and creative ways to sabotage it too. This is one of the hardest truths in trading. The market will hand you exactly what your psychology allows it to. A brilliant strategy executed inconsistently will lose money. A mediocre strategy executed with discipline will often outperform it. Section 3. The fear-greed pendulum. Every trader swings on the same pendulum. On one side is fear, on the other is greed. Nobody escapes it, but the traders who survive learn to recognize which side they're on before it costs them money. Fear shows up as, closing winning trades too early because you're terrified of giving profit back, hesitating to enter a valid setup because your last 3 trades lost, moving your stop loss closer just to be safe and getting stopped out right before the market reverses in your favor. Greed shows up as holding a winning trade far past your target, convinced it will run forever, increasing position size after a winning streak because you feel invincible, adding to a losing position because you're convinced the market has to turn around. Notice something about both lists. None of these behaviors are about analysis. They're not about candlestick patterns or economic calendars. They're emotional reactions dressed up as trading decisions. The traders who make it treat fear and greed the way a pilot treats turbulence, as something expected, monitored, and managed, not something that dictates the flight path. Section 4. Revenge trading, the silent account killer. If there's one behavior responsible for more blown accounts than any other single factor, it's revenge trading. Here's how it happens. You take a loss, a real one that stings. Instead of stepping back, something in you says, I need to make this back, right now. So you take another trade, not because it meets your criteria, but because you're chasing the feeling of being right again. That trade is emotionally loaded from the start. You're not trading the chart anymore, you're trading your ego. And because you're rushed and anxious, you often oversize the position, ignore your stop-loss discipline, or enter at a worse price than you would have otherwise. If that trade also loses, and it often does because you abandoned your process, the cycle accelerates. Each loss creates more urgency, more emotional charge, and worse decisions. This is how a trader can lose a week's worth of gains or even blow an entire account in the span of 20 minutes. The nobody tells you part? Revenge trading doesn't feel irrational while it's happening. It feels justified. It feels like determination. It feels like I just need one good trade to fix this. That feeling is precisely what makes it so dangerous. It disguises itself as conviction. The single most protective habit you can build is a rule that has nothing to do with charts. After a loss that triggers an emotional reaction, you stop trading for the day, not because the market changed, but because you did. Section 5. Overconfidence after winning streaks. We talk a lot about how losses damage traders psychologically. Nobody talks about how wins do the same thing, just more quietly. After a string of winning trades, something shifts. You start to feel like you've figured the market out. Your risk management starts to loosen up. I'll just risk a bit more. I'm on a roll. You start skipping your checklist because you just know this next trade will work. You might even start trading pairs or setups outside your usual system because you feel unstoppable. This is called the hot hand fallacy, and traders are especially vulnerable to it because the market gives just enough random reinforcement to make it feel like skill. A few consecutive wins can happen by pure chance, but your brain doesn't file it under chance. It files it under, I'm good at this now. The hard truth is that the market has no memory and no obligation to keep rewarding you. The same overconfidence that felt like momentum during your winning streak is usually what wipes out the gains a few trades later, because the position sizing and discipline that got you there quietly disappeared. Consistency, not streaks, is what separates traders who last from traders who flame out. Section 6. The illusion of control. Leverage is one of the most misunderstood tools in Forex, not because people don't understand the math, but because they don't understand what it does to their psychology. On paper, leverage lets you control a larger position with less capital. Psychologically, it does something more dangerous. It makes small price movements feel enormous. A 10-pip move that would be a minor blip at low leverage becomes a heart-pounding swing at high leverage. Your nervous system starts reacting to noise as if it were a real signal. This is why over-leveraged traders can't hold a winning trade to its target, because the unrealized profit feels too significant to risk giving back, so they close early. It's also why they can't cut a loser at the planned stop, because the loss feels too painful to accept, so they widen the stop just this once, hoping the market turns around. Nobody tells you that leverage doesn't just amplify your position size, it amplifies your emotions. And emotions, amplified past a certain point, don't lead to better decisions. They lead to panic decisions that look reasonable only in the moment they're made. Section 7. Why your trading journal matters more than your strategy. If there's one habit that consistently separates traders who improve from traders who stay stuck, it's honest journaling. And I mean actually honest, not just tracking wins and losses. A real trading journal doesn't just record what happened, it records why you entered, what you were feeling, whether you followed your rules, and what you do differently. Over weeks and months, patterns emerge that are invisible in the moment but obvious in hindsight. Maybe you consistently overtrade on Fridays, or you always second-guess trades right after a loss, or your best trades come from setups you almost talked yourself out of. Most traders skip this step because it's uncomfortable. It's much easier to blame a losing trade on the market being manipulated or bad luck than to write down, "I entered without my stop-loss criteria met because I was afraid of missing the move." But that discomfort is exactly where the useful information lives. The market doesn't lie to you, your excuses do. A journal strips those excuses away and shows you, in your own handwriting, exactly where your psychology is costing you money. Section 8. The market doesn't care about you. This one is uncomfortable, but it might be the most important truth in this entire video. The market has no idea who you are. It's not testing you, it's not trying to shake you out right before your trade would have worked. It isn't rewarding your hard work or punishing your mistakes. It is simply the aggregate result of millions of participants making decisions based on their own information, incentives, and emotions. When a trade goes against you, it's not personal. When a trade works out, it's not because you deserved it. This sounds obvious, but very few traders actually operate as if they believe it. Instead, they narrate the market as an opponent, something to outsmart, something that's out to get them, and that narrative quietly fuels frustration, tilt, and revenge trading. The traders who last treat the market the way a surfer treats the ocean. You don't get angry at a wave. You don't take it personally when a set doesn't come. You read the conditions, you respect the risk, and you wait for what actually presents itself instead of forcing a ride that isn't there. Section 9. Discipline isn't motivation. A lot of trading advice tells you to stay disciplined, as if discipline is a personality trait you either have or don't. That framing sets people up to fail. Discipline isn't a feeling you wait to show up. It's a structure you build so that good decisions don't depend on how you feel in the moment. This is why traders who last usually have a written set of entry and exit rules they define before the market is open, not while they're in a trade. A maximum daily loss limit that once hit ends trading for the day. No exceptions, no negotiating with yourself. A predefined position size based on a fixed percentage of the account, not a feeling about how strong the setup looks. None of these require willpower in the moment. They require a decision made in advance when you're calm that removes the need to make a good decision under emotional pressure later. That's the real secret behind discipline. It's not about being strong-willed. It's about designing a system that doesn't rely on willpower in the first place. Finally, let's talk about expectation gap, because this might be the root cause of everything we've covered so far. Many new traders enter Forex expecting consistent, fast profits, doubling accounts in months, quitting their job within the year, living the trading lifestyle they saw in an ad. When reality doesn't match that expectation, every normal part of trading, drawdowns, losing streaks, slow months, feels like proof that something is wrong. That emotional gap between expectation and reality is exactly what pushes traders into over-leveraging, revenge trading, and abandoning good strategies too early. Professional traders don't expect to win every trade, or even most weeks. They expect to execute their edge consistently over a large enough sample of trades that probability works in their favor over time. Their emotional baseline isn't every trade should win. It's, did I follow my process? Because that's the only thing actually within their control. If you walk away from this video with one shift in mindset, let it be this: stop measuring yourself by the outcome of your last trade and start measuring yourself by whether you followed the process you designed when you were thinking clearly. So here's the hard truth about Forex that nobody tells you when you're staring at a chart excited to place your first trade. The market isn't the hard part. Candlestick patterns, indicators, support and resistance, all of that is learnable in weeks. What takes years is learning to manage the version of you that shows up when real money, real fear, and real greed are on the line. That's the actual game. Everyone selling you a strategy is selling you half the picture. If this video helped you see your own trading a little more clearly, let me know in the comments which of these patterns hit closest to home. I read every one. And if you want the next video to go deeper into building a trading routine that actually protects you from yourself, subscribe so you don't miss it. Trade safe, stay disciplined, and I'll see you in the next one.